Hello, everyone, and welcome to the ETF.com Emerging Markets Week. My name is Matt Hogan, and I'm the CEO here at ETF.com, and I'll be your host for today's webinar. The idea behind our Emerging Markets Week is to gather together a wide-ranging group of experts for 5 standalone webinars looking at the critical topic of emerging markets and will they recover. We have a great series ahead of us this week, including sessions on emerging markets and smart beta, emerging markets debt, emerging markets and commodities, and specifically how to trade China. So I'd encourage you to log into all of those webinars, one taking place each day this week. But we're in for a treat today because we're kicking things off with a webinar featuring 3 of the smartest and most sharp-witted investors I know, coming together for a broad-ranging discussion on emerging markets and the geopolitical outlook. Joining me on today's session are Richard Bernstein. Richard is the CEO and Chief Investment Officer of Richard Bernstein Advisors. He has more than 30 years experience as an investment strategist and more accolades for that work than almost anyone I know. Just to pick one, he is one of just 50 analysts inducted into the Institutional Investor Hall of Fame. He's also a great presenter. Pleased to have him here. Also joining us today, Dennis Gartman, a good friend of ETF.com and a man I'm sure who needs no introduction to most of you. Dennis is the editor and founder of the Gartman Letter, which has to be one of the best read and most read publications on Wall Street. Dennis is never shy for sharing his opinions. We'll be sharing them today on emerging markets. Also here, Mark Dow, another expert much beloved by ETF.com readers. Mark is a proprietary global macro trader, author of a much-followed blog. He previously worked at the U.S. Treasury Department and has written blog posts such as Why Emerging Markets Won't Crash, which we will talk to him about shortly. So that's a rock star lineup, and I hope to pin them down on the question of where and when to invest in emerging markets. But before I do, a little bit of housekeeping notes. First, the format for today's session will be pretty straightforward. I'm going to kick things off with some opening slides before handing it over to Rich for some slides of his own. We'll then have a Q&A with Dennis and Mark before opening things up for a moderated Q&A discussion. At the end of the hour, I hope we have a bunch of takeaway ideas we can go and put to work in the market. On the housekeeping front, I would like to thank our sponsors for Emerging Markets Week, CSOP, WisdomTree, and JP Morgan Asset Management. I'd also like to thank you guys for dialing in. I would ask you to please be a participant in today's webinar. You can ask questions of Richard, Mark, Dennis, or I using the Q&A toggle on your webinar screen. Please ask them as they occur to you, and we'll collate them and answer as many as we can at the end of the session. Beyond that, I would remind you that you can expand your webinar viewing browser by clicking the Maximize button at the top right-hand side of your screen or dragging and dropping the thing at the bottom. And lastly, you will be able to access a recording of this webinar as well as the slides within 24 to 48 hours after the conclusion of today's webinar. We'll send you an email when those are posted, and that email will also have information about how to qualify for CE credits for attending today's webinar. So that's a lot to cover in one session, but I'm excited for it. I just wanted to kick things off, I guess, by framing the questions I'd like to answer today. Those of you who know me know that I like to run tight sessions with actionable results at the end. And what I want to answer today are the questions, will emerging markets recover? How should we invest in that recovery? What are the risks? And what are the most attractive opportunities? Just to set the stage, let's be clear that emerging markets have been a terrible place to invest recently. Since the turn of the decade, a broad-based position in emerging markets is trading down about 7%, while the S&P 500 is up about 107%. That's a massive swing with the supposedly sexy assets stumbling and the boring S&P up massively. In fact, I could peel back this chart so that it was a 10-year chart and not a 6-year chart, and you would still see the S&P 500 outperforming emerging markets despite the massive gains that emerging market economies have made in the past 10 years. The question I want to ask is, will that continue? Before we do, I would also point out this slide. This takes a look at the performance of individual emerging market countries. It only covers back to 2012 because some of the ETFs tracking those countries didn't launch until 2012. But the thing that stands out from this slide is that it's not one emerging market, it's a series of emerging market countries. You can see at the bottom you have countries like Brazil that have been absolutely slaughtered. You can see at the top that you have a handful of markets that have done reasonably well since 2012, including China, India, and Taiwan. So I also want to talk today about which markets are best positioned for the future, and if investing in quote-unquote emerging markets broadly makes any sense anymore. I think we're going to spend a bit of time on slides like this later today. This is a slide of demographics in the developed versus emerging economies. It shows more or less simply that the emerging markets are in a much better position demographically than the developed markets, and I think there are people on this panel who believe that foretells future strong performance. I want to dig into that a little bit. I also want to look at slides like this, which look at the working urban populations in various areas of the world, both today and 2050, and ask, are there particular emerging markets where the demographic themes are more positive? In short, I want to find out if the recent poor performance of emerging markets has laid the groundwork for a great investment opportunity, or if it's a bear trap and we should stay invested in U.S. equities. So we have the right panel in place to answer those questions. At this point, I'm going to turn it over to Rich Bernstein, who's going to kick things off by framing his perspective on emerging markets and what he sees. Rich, take it away.
Great. Thanks, Matt, and thanks to all of you at ETF.com for inviting me to speak this afternoon. Good afternoon, everybody. I think at RBA, we've been, any of you who invest with us, we're kind of notorious, infamous, famous, depending on which side of the coin you come down on, as being secular bears on the emerging markets. And so what I want to do is present a little bit in a few slides here why we remain these secular bears. Now, look, I'm not smart enough to tell you whether emerging markets are going to outperform for the next quarter. Dennis is much better at something like that than me. But what I'm going to try and explain is that for many, many years, emerging markets had a hurricane force or gale force wind at their backs. They have had, and we think will continue to have, gale force winds in their faces, at least for the next several years, if not longer. So let's talk about why that's the case and why we think that that's the investment climate that we're in. This chart shows you the performance of what we've called credit-related asset classes. These are all asset classes that are highly dependent on credit creation. As you'll note in the chart, they were the asset classes that performed the best compared to the S&P 500 from 1998 to 2008, which we would argue is really the period during which the credit bubble expanded. Remember, everybody thinks it's like a 2007-2008 event, but it really started all the way back in 1998. Of course, it wasn't a bubble back then. It started as something much more benign, but it blew up into something that became this big global credit bubble. And you can see that every credit-related asset class that one could name significantly outperformed the S&P 500 as the global credit bubble was inflating. Remember, these are all asset classes that are very sensitive to credit creation, and as such, as the credit bubble was inflating, they performed outrageously well. But you can see that since 2008, the point at which that we would say the credit bubble began to deflate around the world, you can see that credit-related asset classes have underperformed quite dramatically, almost nearly as they outperformed during the credit bubble. We think, this is the secular theme in the backdrop, is that you want to avoid credit-related asset classes. I think my guess is, most people on this call would probably agree with me that the global credit bubble is in the process of deflating. But then they'll ask questions about energy, or they'll ask questions about emerging markets. They'll ask questions about real estate. They'll ask questions about MLPs. But our point is that, why would we want to invest in asset classes that are dependent on credit creation when we're in a period where credit creation is under immense pressure all around the world, which is what you would expect to see as the credit bubble deflates. Emerging markets are one of these credit-related asset classes. That's often hard for people to understand. Why are they so credit-related? Well, I'll give you just a very easy example of why they're credit-related. I'm sure everybody knows on the call, everybody knows that there were housing bubbles throughout much of the developed world. So if you think about the United States, in London, throughout parts of Europe, in Australia, Canada, at various times, there's been housing bubbles throughout much of the developed world. Well, if you buy a new house, think about everything you need for a new house. Remember, housing is a very high multiplier industry. So you need not only building materials and tractors and everything else, but you need electronics, you need appliances, you need bedding, you need furniture, you need linens, you need lawnmowers, you need tools, you need all this stuff that goes along with a new house. Well, where was all that stuff made? All that stuff was made in the emerging markets. So what the housing bubbles did in the developed world was overstimulate demand for the goods being produced in the emerging markets. And that's really our secular view, is that that's going to continue. Now, what's happened as bubbles deflate, they leave behind tremendous excess capacity. And that's what's happened. As the global credit bubble has deflated, there's massive overcapacity all around the world, and that's what this chart really shows, is capacity utilization on a global basis. And you can see we're well below the long-term average. And what this means is that you're in a theoretical context, it would mean that you should shut down the excess capacity and reallocate the assets for more productive use. Great from a theoretical perspective, incredibly unrealistic in a real world, because no politician anywhere around the world is going to shut down excess capacity and reallocate assets, because that's called unemploying voters. And if you're not in a democracy, that's called unrest, that's called coups, and that's called you hiding on a plane at midnight to go live in exile someplace else. So no politician's ever going to advocate shutting down excess capacity. Rather, what they're going to try to do is use up that excess capacity, provide policies that hopefully use that excess capacity. And you can see we've called this on the chart the Walmart world. And the Walmart world is really one of tremendous excess capacity, meaning countries have to pretend they're Walmart. How did Walmart become so successful 30 years ago? Well, very simple strategy. They undercut the competition to gain market share. Theirs was a whole story of market share gains, not of margin improvement, but of market share gains. And right now, that's what's going on all over the world. Countries are fighting for market share. They don't want to shut down the excess capacity. They're having trouble making themselves more efficient. They're all fighting for market share. Well, if you're a country and you're fighting for market share, what does that mean? It means you depreciate your currency. So what does that mean? It means the dollar, from our perspective, is in a secular uptrend now. That as countries fight for market share, they will continually depreciate their currencies going forward. No country wants a strong currency right now around the world. This is great for the dollar. It's great for the U.S. consumer. It means our purchasing power is going up. On a relative basis, our standard of living is going up. I think this is an incredible story for here in the United States. Now, does that mean you only buy U.S. stocks? Of course not. I mean, we're global investors. We're overweight Japan, we're overweight Europe, but a lot of what we have in our portfolios is in these countries are exporters who export to the United States, because they're the ones that are more likely to gain market share. The translation benefits help them. It does us no good to find exporters in Japan that export to China. That puts us right back in the soup, right? So what we're trying to do is we're trying to take advantage of a strong currency, and who's going to benefit the most from that strong currency. So just to sum up, I have a couple of slides here for the lawyers. But just to sum up, I think, we're really looking at a world with massive overcapacity, countries fighting for market share. Everybody wants a weak currency, tremendous for U.S. assets, very difficult for emerging markets in this environment. Let me just sum up with one thing. In real estate, everybody says it's location, location, location. When times are good, you can go to marginal neighborhoods and try and buy a house in a marginal neighborhood. But when times are bad, you have to buy a house in a good neighborhood. It's location, location, location. That's all that matters in real estate. The argument we're trying to make is that when the global credit bubble was inflating, yeah, you could go and invest in marginal economies, and they'd look real strong because they were the biggest beneficiaries of the expansion of the global credit bubble. That period's now over. It's location, location, location. It's the developed world, and for us, primarily, the U.S., and even more primarily, the U.S. consumer. So, Matt, I'll stop there.
Rich, that's a great succinct presentation. I love it. What would be the symbol that period is over? When would it be time to look at more marginal economies? What would be the telling point?
Well, I think in a way it kind of depends a little bit on what you're looking at and how you're trying to invest. But there's several things that are likely to emerge from this, not to use the word emerging for context on an emerging market call, but several things are likely to emerge. Number one is you're likely to see trade barriers pop up in some countries. That's not happening here in the United States. Actually, in the United States, it's the exact opposite. Not commenting on the good or the bad of the TPP, but the TPP is the exact opposite of what I'm talking about. You're going to get more competition in the United States, not less. That's very good for consumers here in the United States, very disinflationary. But in some countries, you're already starting to see trade barriers pop up as they try to deflect this kind of dog-eat-dog world. The other thing you have to realize, if we're all fighting for market share, the other effect that comes out of this is if you can't compete for market share, what do? You buy it, right? So think about some of the big mergers that are going on, not the tax inversion kind, but some of the other mergers that are going on. Companies are buying market share. And, that through time will start constraining competition as well. And so I think those are the two things that people want to look out for in the next several years are, trade barriers, obviously not in the United States, we're doing the exact opposite, and continued M&A activity.
Great. Interesting. Dennis, let's bring you into the conversation here. You just heard a very succinct and strongly negative view on emerging markets. What's your overall take on broad-based emerging markets? Do you agree with Rich? Are they a buy here, or do you have a different view?
The only place that I'd actually be a buyer at this point, to be quite honest, and first of all, I want to say thank you for inviting me here. When I'm on with a group such as Rich Bernstein and Mark Dow, that's the very cream of the crop. You guys had to go down and scrape the very bottom of the barrel to find me, and there I was. I fill out the forum. The only place that I find myself being even slightly bullish in the emerging markets is China, primarily because of the change that has taken place politically there with the demise, finally, of the One China or the One Child program that went into effect in 1979. I think that was probably the dumbest political decision I can ever recall in my lifetime, having seen putting China into a downward spiral demographically and distorting the growth in population. Let's be blunt. In order to have an economy really growing, you really have to have an economy. You have to have a demographic tidal move from the lower left to the upper right. You have to have population growing, and the populations in China were about to fall off the edge of a cliff. And worse, as far as I was concerned, the advent of a very distended number of Chinese boys being born relative to Chinese girls. Finally, they came to their senses and have changed that. And I think that you're going to see although there will be arguments saying that it is now so firmly entrenched to have but one child, you're going to have an explosion of two children. You're never going to have three, but you're going to have a sharp upturn in two children in the course of the next 2 or 3 years. And that really is going to give rise to an increase in demand for housing, an increase in demand for SUVs, an increase in demand for, as I like to say euphemistically, brass plumbing fixtures. I use that as the generic term for growth in housing in and of itself. I'm very optimistic about what's going on in China. On the other hand, I'm terribly pessimistic in the other areas. Politically, for example, Brazil is in the throes. It looks so similar to what we were going through in the 1970s under Richard Nixon. We had inflation and impeachment. They have deflation and impeachment. Dilma Rousseff, the president, is now suffering from hat-size popularity ratings. She's probably under 9% now, and facing the very distinct possibility of being impeached. She's lost in the past week or two one of her primary allies, Senator Amaral, who has been arrested. Moody's has downgraded their debt. The president of BTP Pactual, Mr. Estevez, has been arrested for a cover-up that relates to Senator Amaral. I mean, things are just going terribly awry in Brazil. And my propensity to have any interest in Brazil at this point, until until these political circumstances are resolved, is very limited. I think politics trumps almost everything other than demographics, and the politics in Brazil at this point are horrific. Rousseff's big problem is the fact that she was, and it's hard for me to believe that this was ever true, but it was true. She was the chairman of Petrobras. How you could take an ex-Marxist, gun-toting revolutionary who knew nothing about the oil business and make her the chairman of Petrobras is still quite beyond me. But she was during Lula's reign as president, and she was inept. Petrobras is now suffering badly. Almost every week, as I like to say, there's never just one cockroach. Almost every week there's somebody new at Petrobras, someone higher up the scale who is being arrested. Dilma says that she knew nothing about the corruption that was taking place at Petrobras. You have got to be kidding me. Of course she knew, but they're having trouble yet finding a direct link. They shall. So until that situation is resolved in Brazil, as I like to say, all investment is the propensity on the part of somebody to do something. My propensity to act bullishly of the Brazilian circumstance is negligible. It's practically nil. One of my best clientele, a large banker who had a huge banking establishment there in Brazil almost a decade ago, a family banking operation, closed down his operation when Dilma came to office. That was enough to tell me to go to the sidelines until I see that same family come back from Switzerland and move back to Brazil, and they are Brazilian. My propensity to act bullishly of Brazil is negative at best. As far as Russia is concerned, you have a very smart guy at the helm there. Let's not kid ourselves. Putin is a brilliant tactician, a former KGB agent, and as I like to say, once KGB, always KGB. You have to be careful who you're dealing with here. But he's a brilliant fellow, and he has, although the Russian oil industry, because of oil prices having collapsed, is under duress, if oil prices were to ever find support again, and they probably shall find support somewhere in the low 30s, I might be interested in owning Russia, but that's going to be quite some period of time in the future. Right now, the political circumstances in Russia are very confused. The situation in Ukraine is getting worse by the day, not better. Ukraine has had its oil supplies cut off from time to time. It has cut off itself cut off electricity to Crimea. You've got an extremely, almost a Nazi-like far right-wing party that's beginning to gain political support within Ukraine itself. Cargo traffic between the Ukraine and what they refer to as occupied Crimea is coming to a halt. Russia has said that it's going to sanction food movements into and out of Ukraine. It's just too confusing at this point for me to go rushing into Russia. So I will tell people, be careful there. Going back to the one place that I do find support is China. Again, because I think that the demise of the long-held one-child policy has been put to bed. I think that's going to be inordinately bullish in the long term for the Chinese. I have a great deal of respect for Mr. Xi. He has cracked down on corruption at almost all levels. And this guy, I think, is interesting because he has gone after even former members of the Politburo. He has been fearless in the manner in which he has arrested, sent to trial, and put in prison or actually put to death high-ranking members of the Communist Party. And I think he's clearing things up from what has occurred over the course of the last 10 years or so, as wealth in China has increased, but corruption has increased. Xi is smart enough to understand that he has to get corruption under control. He's getting it under control. And if I had to buy someplace, especially after what happened today with the IMF agreeing finally, and I think this was the right decision, to include the renminbi as a part of the special drawing rights, making it what I think they're going to give the renminbi 10.92% of the SDRs beginning in September of 2016. They're going to reduce the size of the euro in the SDR. They're going to reduce the size of the yen in the SDR. They're going to leave the dollar at its present level for all intents and purposes, but they're going to leave sterling effectively unchanged. But they're going to move the renminbi in. I think that's an endorsement of the Chinese economy generally. I think China's doing all the things right, more than almost anybody else. They have gone about the process of diversifying their oil imports. I wrote today about the fact that I found it fascinating that Angola has become the second largest exporter of crude oil to China, barely behind the Saudis. This clearly is not going to make the Saudis happy because the Saudis, as Rich would say, are fighting for market share, and in that fight, that tends to put downward pressure on prices. I think the Chinese have done a lot of things right. Everybody I know is bearish of China. All the smart guys seem to be bearish of China. And as I want to say, we have to understand that the Chinese population has leaped from the 14th century. I mean, if you lived 100 miles to the west of Beijing, your life has not changed much or had not changed much until recently. It was very, very like that of your parents, very like that of your grandparents, very like that of your great-great-great-great-great-grandparents. And in the last 15 years, you have come from the 14th or 15th or 16th century, leaped into the 21st century, in many instances regarding transportation, the internet, communications, bypassing the 21st century and going into the 22nd century, and they're not going to go back. So I'm amused by the number of people who constantly try to find things wrong with China, have told me consistently that the housing industry is going to collapse in China. Yes, I understand that the Chinese economy 10 years ago was growing at 12 to 15% and is now probably only growing at 5 to 6%. But let us remember that in the course of the last 15 years, the Chinese economy has doubled in size, and a 5% growth rate has the same effect internationally as a 10 or 12% growth rate did 10 years ago. So I think we should be more beneficent towards, more amenable towards China than any place else. If I'm going to be a buyer, let me buy Chinese stocks. Let me avoid Brazil. Let me avoid Russia. Let me avoid most other places. But I can conjure up and put together, especially after the fact this morning, as I was about to say, that we opened sharply lower, had stocks down almost 5%, and they closed 3% better. That's impressive. That's amazing technical circumstance. Maybe today was the low in the Chinese stock market.
There you go. A call for today on China. At least we get an inkling of bullishness from Dennis. Mark, bring us home on the broad-based view. You've heard Rich and Dennis. From your perspective, are emerging markets in general a buy here, and what do you agree and disagree with what those guys just said?
Sure. Let me run through my framework. I know you've heard it before, Matt, over recent years. In 2011, kind of commodities and emerging market equities peaked, and I wrote it. China was very much a driver, I think, to a large extent. It's still it's the touchstone that people use, that and Brazil, to check the health of overall emerging markets. So there are a lot of reasons why China was going to slow down, and the rest of the emerging markets were going to join it, and it was mostly the credit expansion story that Richard spoke about earlier. Now, what he didn't mention that I think is important is they started from a much lower level. So cohorts in South Africa and Brazil who never seen access to credit before, all of a sudden could buy things on installments. So they levered up significantly, but from a very low base, so they didn't get to the high levels that we did in the United States. This is part of the reason why I think emerging markets will digest these imbalances better than they have in times past, and this is an important point I'll circle back to. So I think this process is protracted. It's gonna last a while longer. I'm not shorting emerging markets actively the way I was a while back, but I don't want to buy them. The three things I think that we need to see for asset allocators to get back involved in emerging markets are the same that I've been talking about. One, the dollar. The dollar doesn't have to turn, but we just have to have a credible story of it turning in the future. We have to see sometime, be able to project and say, I'm confident the dollar is going to turn within the next 12 months, 18 months, 6 months. And so far, the fundamentals really haven't lined up that way. Currencies drive emerging market perceptions dramatically. Local currency debt and equities, their returns are dominated by currency, and not always justifiably, we use currency strength as a proxy for the overall health of an economy, right? So until people see the currencies stop depreciating, or they can forecast with some degree of confidence currencies stop depreciating against the dollar, it's going to be hard for asset allocators to go back in. The second is interest rates, and it's somewhat linked to the dollar, but probably not as much as people suggest. We need to know kind of when and at what level the Fed is likely to stop raising rates. Again, we don't have to know for sure. We just have to have a credible story that they're going to stop. The terminal rate is going to be 2.25%, and it's likely to happen 3 years out. Or I'm throwing out random numbers, but that's the concept. We're at the tail end of the process of guessing where the interest rate hikes are going to begin. So that needs to kind of be under our belt as well before asset allocators get comfortable with going back into emerging markets. The third element is a growth differential. Emerging markets, they don't have the legal framework that we have, and property rights and things like that. Corporate finances can be dodgy, and things can happen on the fly. Where the bottom drops out underneath the name that you've owned. So to be compensated for that additional risk, traditionally you need a growth differential. You need to be able to project that emerging markets are going to grow at a rate faster than that of the developed markets. And that too, we're just not there yet. They're still digesting the credit that they built up over the past, pick a number, but anywhere from 5 to 12 years. So that's where we are. The story with commodities is there's a link to them, but it's not as fundamental as people think. If you look at the main emerging markets, you can see China is a massive commodity importer, right? Taiwan's, Korea, Turkey, a lot of these countries are importers. So that old story that we knew once upon a time, that developing economies export primary goods, and that dictates, and their price dictates their fate. That world's not there anymore. But because they've traded together, we kind of have that in our mind. That correlation is there in our mind. And emerging markets and commodities they reside on the same end of the risk spectrum. So they trade together. But the fundamental link is not there. So this is why I don't think we necessarily need a rebound in commodities for emerging markets to do well. But it would certainly help because the correlation people have in its mind. And also, if the growth differential is returning to emerging markets' favor at some point in the future, that would probably be favorable at the margin for commodities. But the main point that Richard made earlier and Dennis alluded to, that we had a super cycle in commodities, and we have a super cycle in emerging markets, if you want to call it that, leading us to overstate the fundamental qualities of those emerging markets. Now, of course, we're understating them because the prices are bad, but that whole cycle is just playing out, and it's going to take a while. It's going to take a while to finish it. So that's I'm not as bearish as I used to be, but in the sense that I'm not actively shorting, but I'm certainly not bullish. I think I want to finish on one concrete point about the commodities that I think a lot of people have wrong. People think Brazil sold commodities to China, and that was the nature of their boom. And just to lay out the facts, when the boom in Brazil started in 2003, 2004, exports were about 16% of GDP. Today, after a supposedly export-led boom, it's 12% of GDP. Domestic credit to the private sector went from 30% of GDP to 70% of GDP. So you tell me which one was the driver. We still think of Brazil in commodity terms, but it's a relatively closed economy, and like Turkey and South Africa and Korea and most of the other emerging markets, they benefited from a global financialization where credit practices developed in the developed countries spread throughout the emerging markets and led to a boom. One final thing before passing the mic back. It's important to note there's significant differences. So something Rich didn't point out, and I would, is that emerging markets have improved under the surface. Yes, we overstated those improvements when prices were high, and we're going to understate them when prices are low. But they moved away from the fixed exchange rates that they used to have. So now the repricing of risk is continuous rather than disruptive, discontinuous moves. That matters a lot for psychology and the psychology of panics, which emerging markets have been known for historically. Second, they have built up a lot of FX reserves over the years because of it in the past. Also, they've been shifting, the sovereigns have been shifting, not the corporates, but the sovereigns have shifted their funding from external markets in a foreign currency to local markets in domestic currency. This is a huge advantage for their sustainability and the way in which they can manage downturns compared to the past. A lot of people they say emerging markets are bad. You scratch the surface and the old prejudices come out, but it's different for those reasons. The other thing that's extremely important in emerging markets that wasn't there 10 years ago was the depth of local markets. So now when you need to sell, it used to be, is Bill Gross in or out? Or are the big tourists getting into emerging markets or out of emerging markets? And they didn't discriminate across countries, and you can make a good argument for analytical argument for doing so, but they don't, and they probably won't for a long time. It's just the way the investment world works. But now when Bill Gross needs to get out, their insurance companies, their asset managers, there's a whole financial infrastructure in almost all of these emerging economies to provide a bid. Again, more continuous pricing. And nothing scares people more than air pockets, discontinuous pricing. Speed is much more than level. Speed gets our psychology all worked up. So I think that the fact that exchange rates move more slowly, more continuously, and the markets absorb these shocks more continuously, reduce the chances of this kind of crises in emerging markets that we remember from once upon a time. And they'll be under pressure and they'll underperform, and that will give them time to digest their imbalances.
Great thoughts by everyone on the panel. I'd remind the audience, you guys can ask questions of any of the three panelists using the Q&A toggle at the bottom of your webinar screen, so please do send them in. Rich, I want to bring you back. This panel is more united in its bearishness than I anticipated, I guess, at the start. My question to you, does it ever become just so cheap that you have to buy? No one really spoke towards valuations, but does it ever get, is it ever just so cheap that you stomach the negative headwinds, the gale force headwinds that you said, and jump in anyway?
Right. Great question, Matt. For us, the way we invest, something being cheap is not reason enough to purchase the particular asset, whether it's a stock or a country or whatever. It's not enough. We like to see cheap assets with improving fundamentals and nobody believes it, right? In other words, the sentiment is so bearish that nobody believes the improvement in fundamentals. Well, the first thing is, are they cheap? Yeah, I think one could make an argument that emerging markets are undervalued to some extent. I'm obviously not, I would question the asset values and the valuations of those assets relative to other people, but you could probably make an argument that they're cheap. Are the fundamentals improving? No. That's the thing that we look at. Now, what do I mean by fundamentals? To us, fundamentals are only one thing, and that's corporate profits. If you're an equity investor, there's only one thing that matters, and there's two things that matters, profits and interest rates, and that's about it, right? In a basic valuation formula, your numerator is going to be earnings or some cash flow number, and the denominator is going to be interest rates. And all that matters are earnings and interest rates. There's no GDP there. There's no, politics. It's earnings and interest rates. So when you talk about fundamentals, you have to look at corporate profits. One of the reasons we've been so bearish on emerging markets is that for almost every quarter, not quite, I'm exaggerating a little bit, but almost every quarter in the last 5 years, emerging markets have led the world in negative earnings surprises. So from if I created a portfolio and I said, gee, I have a portfolio or I have a fund that's made up of the most disappointing companies in the world, people would laugh at me. They'd laugh at me. Nobody would invest. But if I said to you I have an emerging market portfolio, all of a sudden everybody's very interested. And our point simply is that as long as the emerging markets continue to basically lead the world in negative earnings surprises, we're going to have a tough time investing there, because it's not only that they're negatively surprising, but the persistence of it means that from a sentiment point of view, people won't give up. They still think that they've got to turn around. They got to turn around. They got to turn around. It's only a matter of time, and they refuse to give up. And it's the persistence of the negative earning surprises that keeps us on the sidelines with respect to emerging markets.
That's a great answer. Dennis, one area of the emerging markets which you didn't mention and which perhaps has had fewer negative surprises than others was India. That was certainly sort of the consensus EM trade 9 months ago. Since you didn't cover it in your BRIC overview, is that attractive? Does that escape Rich's concerns?
It is more attractive than, let us say, Brazil is. It's probably less attractive as far as I'm concerned than is China. The only reason I relegate them slightly less than China, but well above Brazil, is that I'm a great fan of Mr. Modi. I think that he has done stellar work in revitalizing the economy. I think he's going to do even better work in the years ahead. I'm much impressed by what he's trying to do. The problem that India always has, its great benefit, is that it has probably the best respect for law, remnants of British colonialism. At the same time, it has the most hidebound bureaucracy probably known to man. I think I used to quote the fact that there are almost 100 times as many people in the Reserve Bank of India as there are in the Federal Reserve Bank here in the United States. That gets a little, and I don't think I'm far off the numbers, but it shows you the egregious bureaucratic red tape that one has to go through. So that's the only reason that I put them behind the Chinese. Their demographics, on the other hand, are far better than anything the Chinese has. It's a far younger country, and give me younger countries above older countries any time. That's certainly one of the reasons why I put them far above Russia and even somewhat above Brazil. So if you made me take the BRICS and rank them, I'll put China as number 1, I'll put India as number 2, I'll put Russia as number 3, and Brazil out of the 4, I'll put it 7.
So you still love Brazil. I hear you. I hear you on India. Mark, I wanted to bring you in. The other guys sort of laid out areas where they are more bullish. Rich on the U.S., Dennis edging into China. We didn't get to you. Is India a place that's attractive to you? Are you more attractive to developed markets? Are there any places that you do like?
I mean, for me, I think the easiest thing is to stay away until the tide starts to turn. It's just much better to sail when the wind is at your back. I know we should discriminate across emerging markets to a greater degree than we do, but we don't, and I'm not going to fight it. So when we get to that point, either you have the strategy of picking high quality, maybe a barbell of picking high quality names in various countries, and then maybe some that are just really, really beat up looking for the slingshot beta play. But there's nothing I'm that interested in doing. What I think might be attractive, and if you notice lately, I look at currency. I'm involved in currencies a lot for myself and my clients, and I put them in 3 basic baskets. One is funding currencies. So this would be the dollar, the euro, the Japanese yen, the Swiss franc, the pound, gold, all of these things. That's how I define that. And then there's the risk currencies, which are primarily emerging markets. And then you have petrol currencies like the Russian ruble and Norway, those kinds of countries. So if you notice lately, the risk currencies have been doing better than the funding currencies. A lot of people just look at the DXY, and that really just means the funding currencies. So the dollar's doing well, but the depreciation of the emerging market currencies has decelerated, and it's really important. I think the dollar, is particularly against funding currencies, is on its leg up, but I suspect that this time it's not going to scare people as much because people are ready for it psychologically, and the speed is not likely to be as rapid as last time when so many people were caught off guard. People are positioned for a longer dollar now, so you might want to fund a basket of local currency debt or local currencies in a basket of funding currencies. I suspect it's too early for that trade, but the carry is good, and it's the safest way to put your toe in the water if you want to do it now, because I do think you've got some cushion. You've got some cushion there. But I do want to say something as well about China. I know I'm less sanguine than Dennis is, only because if for no other reason than the one-child policy ending, it's not going to have an effect for 20 years anyway, and their demographics are really bad. They're in the process of going from, and I wrote this back in 2011. You can see it on my blog. from 10% to 3% growth, and we haven't finished pricing that in. Now, 3% growth might end up being a 5% number, official number. Who knows? But their demography is slowing down rapidly, going through a transition, much like Japan did. But Japan did it at a higher level of per capita income. So until we've digested this, if you say to most people China's going to be growing at 3%, that would still shock them. That would still be a negative surprise, even though a modest one. And until we've internalized that, it's hard to say that the sentiment has really gone too far. I mean, China has a list of reasons why this is happening. It's not just demographic, but it's happening. I'm not a panda mugger. I don't think China's going into crisis. Everyone looks at their liabilities and doesn't look at their net liability position, which is much better. I think they can manage it. They have a history of being pragmatic managers. They experiment in regions and then broaden out to the country. They do a lot of good things. So I think the odds favor them managing the transition with bumps and bruises, but not cataclysm the way a lot of people are expecting. But still, until I see expectations for Chinese growth down in the 4-3% range, I don't think the pendular swing of sentiment against emerging markets will be over.
Still too much bullishness latent in EM. Hearing that from all of you guys. Rich, does this mean that your clients have zero position in emerging markets at this point, on average?
Yeah, in our portfolios, I wouldn't say we have zero, but I would say virtually zero.
Right.
There is a little bit of exposure in some of the ETF portfolios that we run that we just can't eliminate. But the better way to think about it is over the last 5 years, or 6 years since we started this firm, the most bullish we've been has been an equal weight in emerging markets. The most bearish has been virtually zero. So we're still pretty bearish. We're still pretty bearish.
That's interesting. Let me search further afield. I'll stay with you, Rich, into frontier markets. Do you guys follow that, or is there any opportunity there? I'm trying to search for some place to get people excited about.
Some place to get people excited about. How about Des Moines?
Give me.
But anyhow, I think frontier markets, and I know Dennis has written a lot about frontier markets through the years, and I'll defer to some extent to him. But I would say, some of the enthusiasm for frontier markets that we saw 3, 4, 5 years ago was the enthusiasm for emerging markets on steroids. Emerging markets no longer good enough. People had to take more risk someplace else. So I think that was part of it. The other thing is that I think it's very hard to think of frontier markets as an asset class, because people always talk about the difference in economies, and I think that's probably fair, because in one economy you may actually have something good going on. In another economy you could be having a coup. So the spread of returns, my guess is, I don't know this for a fact, but my guess is the spread of returns is actually quite large. But as an asset class, I don't think that they're really very attractive relative to developed markets for some of the reasons I mentioned before, because they do tend to act, although not all the time, and I understand the frontier markets guys say different things, but they do tend to act overall like emerging markets on steroids.
Dennis, let's go to you. Is it EM on steroids, and is that a good thing or a bad thing right now?
Rich's point, I think, was very valid. That back at the turn of the century, when everything was going well, you could go to the marginal areas, you could go to the frontiers, you could go to Angola, you could go to Kenya, you could go to Zimbabwe, you could go to South Africa. And the punt was a decent punt. Now I think that the punt is a bad one, and I think if you try to punt it, it will be blocked. So my interest, my enthusiasm, my propensity to do anything in the frontiers is almost non-existent. Remember, all I run is my own money. My wife lets me keep a couple $1 million in my trading account, and I put my money where my mouth is. I haven't penny one in the frontier markets, nor shall I.
There you go. A reminder to the audience, you can ask questions using the Q&A toggle, which should be viewable now if it wasn't before in your audience screen. Mark, let's bring you in. Specifically,
Yeah.
I don't know if you follow it carefully, but I've been hearing a lot of chatter about Argentina as a potential hot trade as we go into 2016. Any interest in Frontier or any interest in Argentina?
No, I mean, I know it's a country I know extremely well, but and there's some hope around Macri, just a change, but and it might help for a while, but Argentina, if its neighbors aren't doing well, primarily Brazil, it's not going to do well. It just doesn't have the infrastructure. So we'll get some hope around Macri, and he'll do better. He'll make better policies. But the history of Argentina is when the cycle starts to turn and things get rougher, the politics revert to bad economic policy, and it's happened for 100 years. They've been on a downward slide. They've had Menem, and they've gone through all kinds of permutations, every economic arrangement possible, and it always ends up under pressure, and they're reverting to the old bad policies that end up blowing the country up. They can change at some point, but their problem is cultural. They vote for the same guys. They have a heavy patronage system, so it's not good. Yeah, you can get a little bit excited about it, like I say, but I think this: if you're an asset allocator, if you're sitting above at 39,000 feet, you just don't want to go and fight the headwind. You want to go when the wind is at your back. So it makes no sense really to have a meaningful allocation. Yeah, maybe if you find something distressed that you like at a really good price, okay, but as a general theme, I don't think it makes a lot of sense. And frontier markets even less. They're like emerging markets, but without the wonderful liquidity and brilliant fundamentals. So it's super high beta and just a nightmare to get you get in Nigerian bonds and you're just not getting out when things get at the smallest bump. So I don't mean there aren't things to do tactically. There will be moments when pessimism gets extreme. And we'll bounce around the bottom. As I said, I don't think emerging markets are going to fall apart, and there'll be plenty of opportunities for people to get too bearish and scalp a trade over a shorter horizon. I don't think we're at that point right now, though. What's interesting is in the last few years, because emerging markets have been beat up, people have tried the end of the year dogs of the Dow type trade. They say, oh well, it's got to come back. Look how much it's been beaten up, and they'll buy it. And then a few months into the next year, they'll realize the fundamentals aren't backfilling, they aren't validating their positioning, and then they fizzle again. That could happen again this year, right? That's quite common. But for the fundamental trade, I don't see it there. Stay away from the frontier markets. If you're clever and watching Argentina closely, and you think you find some assets that are well priced, okay, go for it. But I think you're swimming upstream. You better be a strong swimmer.
There you go. Well, it's difficult when bullish is fading a behavioral mistake. But I guess that's where we are. Dennis, a question for you that's coming from the audience. If you are bullish on China, are you worried about currency depreciation there?
No, actually, I'm worried about currency appreciation, if anything. If you listen to our political leaders, if you listen to the Donald, he's talked about the fact that the Chinese renminbi has fallen in value. I'm wondering what chart he's looking at. The Chinese renminbi has been strong over the course of the past 6 years. I'm actually more worried about appreciation in the renminbi than I am about depreciation. So no, I'll put that on a shelf someplace else and let the Donald worry about that improperly.
There you go. All right. Well, we have about. Yep.
Hey, Matt,
yeah, go ahead.
I think it's super important. I think the Chinese currency has been grossly misunderstood. If you go back, roll tape and look at the history, for a long time they kept the exchange rate artificially depreciated so as to build market share and become the export machine that it became. But I'm going to say about 4 years ago, 3 years ago, they changed policy. And to facilitate the transition from an export-led economy to a domestic consumption-led economy, they allowed the exchange rate to get too strong, right? And this is what I think Dennis was referring to. So this happened, and this move a while ago that people overreacted to, they just said, okay, that's not good either. Our long-term plans are for China is for the renminbi to be a reserve currency, for China to be a functioning part of the global economy. So our financial weight matches our economic weight, and we become more integrated, and we assume our place in the pantheon kind of thing. And that's what this thing was about. They said keeping it too cheap, keeping it too strong, it ends up being a huge pain in the butt. Now let's just manage it less, just keep it smooth, and so that people don't panic with sharp moves and allow things to evolve. That's what the so-called Chinese devaluation was about. So if the dollar continues to appreciate, the Chinese renminbi probably should depreciate, but it's just a lot less. It's a lot less big deal than people have made it out. They're all looking at it through a mercantilist prism, and they're wrong. The second reason it's wrong for looking at things through a mercantilist prism in China is the import value of their exports is 40, 50, 60%. It's come down from the higher levels, but it's still quite high. So you're not really gaining that much if you depreciate or appreciate. In the sense that your inputs cost more or less and offset most of the gains. So people don't look at this a lot. When they look at an exchange rate move, and don't look at the openness of the economy. What is the share of exports in GDP? They kind of assume that everything has the same effect on everyone. You have to look at that. And the second thing is the value added in your export sector. Because if you're only adding 5 or 10% value, the exchange rate move doesn't matter a whole lot. Because your input price move is offsetting the gains that you might get on exports or vice versa if the currency moves the other way. If, however, your value added is extremely large, like 80%, then your economy will be more sensitive to exchange rate moves. People need to take those steps, and when they do in China, they realize that it's not as open an economy as they think, and it's not as sensitive to the exchange rate. The final thing I'll say on this, a lot of countries like China that are just plugging into the global financial system have their GDP horribly underestimated. And the sector that's underestimated is the non-tradables, the haircuts, the things you can't count, the things that people deliberately hide so they don't get taxed. So if you look at China's exports to GDP, you have to haircut it by the misestimation of GDP in terms of level and by the degree of added value in their exports. And once you do that, you realize it's not that big of a deal in the case of China.
All right. Well, we are almost out of time. I will ask for a 30-second answer from each of you. We spent a lot of time on areas that we don't like in the emerging markets. Rich, if you had to make one bullish recommendation across all possible opportunities, including developed markets, where would you tell people to put their money today?
That's actually a tough question for me. I would say, and not a very original answer, if you're forcing me to invest in emerging markets, I'm going to stay as close to home as I possibly can. And I'm going to say Mexico, because I think, Mexico's the remora that swims with the shark, and we're the shark, and they kind of grab onto us. And I'm not sure that works every day of the week, but I think there's something there. So if you forced me, I don't want people to believe that we have positions in Mexico, but if you forced me, that would kind of be my choice.
Well, I appreciate you doing that. I was actually giving you an out. I was going to let you choose any asset class, including developed, but thank you for Mexico. I appreciate that. Dennis, for you, it's China?
Yeah, I think the trade for me would be to be an owner of the Shanghai Composite, and as a commodity trader, having grown up in the pits in Chicago, we are always a buyer of one thing and a seller of something else. So if I have to do it, if I have to only trade in the emerging markets, let me buy China, let me sell Russia. I think that's probably what I'd like to do. There
you go. And Mark, last word. Any thoughts?
If I were buying something in emerging markets, I would build a basket of currencies and a handful of the benchmark emerging market currencies, and then short on the other side a basket of the funding currencies, and that would include the dollar to be a little bit hedged against counter moves in the dollars they come. So you want to be short some dollars against them, short some euros against them, and short gold against them. Those are the three currencies I would. And as an outright trade, I know, listen, I've been saying this for a long time, and it's come a long way since 1750, but I still think gold is short. People bought it after the crisis for all the wrong reasons. It had a nice run up until that point. Got to 700 or 800, and then we had the QE and all these other things that people thought were going to produce effects that never materialized. And my supposition all along is people bought for all the wrong reasons. None of these things are happening, and we're going to go back to the status quo ante, as it were, to the level of gold that we saw before the crisis, and that's 700 to 800. And maybe we overshoot. I don't know on the downside. I don't know, but I think it's a good short.
Well, there you go. Great answers. I appreciate you all playing along despite the general bearishness on emerging markets. I certainly learned a lot from today's webinar. Some great insights. Rich, Mark, Dennis, thank you for participating. You guys can find out more about their firms at the websites of Richard Bernstein Advisors, the Gartman Letter, and the Behavioral Macro blog of Mark Dow at markdow.tumblr.com. I'd like to thank our sponsors for making Emerging Markets Week possible here at ETF.com. That includes CSOP, Wisdom Tree, and JP Morgan Asset Management. Please do visit their websites as well to learn about the emerging market solutions they provide. For those of you who are interested, down at our big Inside ETFs conference in Florida in January, we will have both Rich and Dennis reprising and advancing this conversation on an emerging market debate along with Mark Faber. That should be a fantastic session. So register to attend Inside ETFs. Who knows? Maybe they'll be bullish. If not, at least we'll have the updated view. I'd like to remind everyone to please attend the rest of the webinars for our Emerging Markets Week. That includes tomorrow's session on emerging markets and smart beta, new approaches, taking place at 2 p.m. Eastern Time. You can register if you need to at ETF.com. A recording of today's webinar and a copy of the slides will be made available on ETF.com within 48 hours of the conclusion of this webinar. As a participant, you will get an email alerting you when those slides are available, and that email will contain information on how to qualify for CE credits as well. Most of all, I would like to thank each and every one of you for taking an hour out of your day to tune into this great discussion on emerging markets and the challenges they face in the year ahead. I hope you have a great rest of your day, an excellent week, and a profitable 2016. For now, this is Matt Hogan, CEO of ETF.com. Have a great week, everyone.